Hello, everyone. Thank you for joining East Daley's 3Q Capital Intelligence webinar. We're just going to wait a couple minutes to let some people roll in, and then we'll kick it off. Thank you.
All right, everybody. Thanks for joining us today. This is Chris Noonan, and I'm joined here today by our Capital Intelligence Analyst team. I've got James here, Gage, and Zach, and I also have the head of our analyst team, Ajay Bakshani, with me as well. So first things first, let's go through the agenda. So one theme you're seeing us cover a lot is commodity ties. It's a big theme of ours. We believe, and we're going to keep preaching this, that commodities are more tied together than they ever have been, and you have to watch all commodities to know what's going on and to make money in this market. We'll go through our supply outlook. Is production going to show up in the back 4Q of 24? And then NGLs, right? We've heard a lot about NGLs. Where are those barrels coming from, who's profiting from them, and such. And then Blackcomb, that's the newest, biggest pipe. We're all excited about it. It relieves some pressure to Waha, but what's going on? What are the dynamics behind it? And then Bakken crude fundamentals. Move over Permian. The Bakken is interesting again. All right, so first things first. Increased volatility and the impact on infrastructure. 4 things to remember. So this is what we're going to cover. 4 things to remember. Crude oil, natural gas, and NGLs are all linked together. So when we talk to traders, both gas, crude, and NGL, they have to understand how all of these commodities are linked together. You can't ignore one or the other anymore. Number 2, this isn't your father's oil and gas market. The US is the major supplier across all 3 hydrocarbons. We're all trying to export. All companies are trying to export. So again, you have to watch all 3 commodities to understand one. Third, the US is unique. We have thousands of individual players, not like other countries where they have one or state-owned. So every basin, every upstream player, every midstream player, and every downstream player is unique. So it makes for opportunities across the board. And 4, production and capacity is in the fastest growing basin in the US has doubled in 6 years, in the last 6 years. So we've never been in a market. Again, all 3 commodities tied together and large amounts of production and with everything going to the water. And now I'll turn it over to Ajay. We're going to look at the Permian because that is the epicenter of volatility. Ajay?
Yeah, thanks, Chris. The Permian is the perfect example of what we're seeing here. Gas production in the Permian and egress capacity has doubled. Crude has nearly doubled, and NGLs have more than doubled. So getting your molecule out of the basin has gotten harder, and prices have just gotten more volatile. We see it in the Waha price. On the graph on the right, the light blue shaded area is the upper and lower bounds, monthly average prices, and monthly average prices have been negative for most of the year so far. Part of that is new infrastructure is getting harder and harder to build. Producers don't want to pay to overbuild the basin. Midstreamers don't want to destroy legacy rates like they did with crude pipes in 2019. And the regulatory burden is a lot higher these days. That means there's going to be more constraints and just somewhere along the value chain, both across commodities and geographies that interplay with each other. In the Permian, we have gas constraints, and they've been putting a lid on Permian crude production growth so far this year. Once Matterhorn comes online and you see some increased Permian activity, that's going to start filling up Permian to Gulf Coast capacity on the crude side. On the flip side, crude did dip to $65 a week or two ago. So, lower crude prices could portend lower Permian crude production, but then that means lower gas production. And then you might need even higher gas prices to incentivize more production from the Haynesville, Barnett, and Anadarko to supply the incoming LNG demand. So beyond the commodities, geographies also matter as well. As we're going to talk about shortly, Matterhorn solves Permian gas constraints, but then it's going to cause constraints down at Houston Ship Channel.
Oh, that's awesome, Ajay. Thanks. So I think everybody wants to know, we have Matterhorn coming online, and we're going to get into our supply outlook. Let's take a look at our growth across commodities in the lower 48.
Yeah, so Matterhorn is key. Oil production's been flat year to date, even slightly down. We had a big ramp up last fourth quarter into winter, but then the January storm dented a lot of that, and production's barely recovered. Producers have typically guided to second half growth, and more recently, some producers like Diamondback have explicitly stated that they're waiting for gas egress. As a result, we expect a big ramp up in 4Q as producers aim to hit their 2024 exit rate targets and meet their gas egress commitments. On the gas side, we expect production to not only ramp up into the winter as it seasonally does, especially in areas like the Northeast, but you also have Plaquemines Phase 1 starting up, as well as Corpus Christi Stage 3. The delay in Golden Pass smooths out the growth, which is probably healthier for prices longer term, as producers don't need to ramp up too fast and then suddenly trip into oversupply. So we expect production to flatten out in the second half of 25 and then ramp up again in 2026, with prices typically in the $3 to $4 range. On the NGL side, high ethane recovery has kept production growing in the Permian, which makes sense given negative Waha prices. So Matterhorn should relieve that, which will probably slow down overall NGL growth just as more ethane gets rejected. But we do see it being a long-term driver, especially if C3 plus growth with just higher drilling in the Permian.
Awesome, thanks, Ajay. So you ended with NGLs there, and I think this is a good segue to talk about NGLs. One thing with NGLs that we're seeing is you got plenty of pipe space, but there's other pieces at play that people have to watch out for.
Yeah, I think one of the biggest questions we've gotten is if infrastructure is moving too far ahead of production, especially on the NGL egress side in the Permian. So based on the chart on the left, where the stacked area represents volumes by pipeline and the black line is capacity, it very much seems that way. So there's definitely risk to current Permian transportation rates, which are about 7 to 8 cents a gallon. The fact that plants in the 2015 to 2019 build out of infrastructure are likely to have contract roll-offs in the coming years adds even more fire to the rate risk as these NGL midstreamers fight to retain those barrels. One thing I will point out, though, is that fractionation is actually relatively tight. So there might be a potential hedge on those falling transportation rates if the frac fee is going higher. So as you could see on the red line, that's showing fractionation utilization at Mont Belvieu in the Texas Gulf Coast. And that's essentially been at 100% of nameplate capacity. So yes, these fractionators can run above nameplate capacity, but even on an adjusted basis, you're looking at 90% plus utilization. So you might lose a few cents on the transportation, but again, on aggregate, the transportation and fractionation rate, and you might lose a few cents on the aggregate T&F rate, but most of these companies own both transport and frac, so you might be able to make up a couple cents on the frac. Another offset to the potential overbuild are those with integrated G&P systems, where you have more control of the flow of NGLs and ensure that the supply to your downstream pipes, fractionators, and export terminals can be met. So pipes with weaker GMP support, they're the ones that primarily are going to have to compete by cutting that transportation rate.
All right, thanks, Ajay. So one question we get asked a lot is about producers, right? So how do you see producers taking advantage of in this market with the NGL barrel?
As Permian producers consolidate, they may want to control the flow of their own NGL barrels and dig into those midstream fees a little bit more. However, that's the other thing with owning the GMP assets. It allows you to do is discount more aggressively across the functions, whether that's by bundling, providing marketing services for the NGLs, or opening up exposure to the export markets. So it's no surprise that these integrated NGL midstreamers are also investing heavily in GMP. Between the year-end 23 to year-end 27, we expect processing capacity in the Permian is increasing by about 6.3 BCF a day of capacity. So you can see that on the left chart. The stacked area charts are capacity by company, and the black line is Permian gross gas production. So although it seems like, one thing I want to note is that although it seems like production is well under total capacity already, that a lot of that capacity is ineffective. There are older plants with less NGL recovery potential, or in areas with little new drilling. On this next chart on the right, we break down that capacity growth in our table. So Targa and Enterprise account for nearly half of that growth, and adding in Energy Transfer after accounting for the recent WTG acquisition, those three companies are leading about, or make up about 65% of the total GMP capacity growth in the basin. And then as we move towards the right side of that table, these integrated companies that have invested the most heavily in GMP have also translated that growth to downstream expansions. So Targa and Enterprise were the first to announce their NGL pipeline expansions. Enterprise has gone a step further in significantly expanding its C2 and LPG export capacity. And ET management has openly talked to the strategy in their last earnings call, saying that they don't even pay attention to what others are doing in NGLs. They're just focused on supporting their own system and downstream contracts.
So Jay, thanks for covering capturing the full barrel and NGL infrastructure. The one big acquisition merger everybody's talking about is ONEOK Enlink. What are your thoughts around that? Was it a good acquisition? How did they capitalize on this?
Yeah, I mean, I think it was a great move strategically, and it follows sort of the playbook that these other integrated NGL midstreamers have been doing. Enlink provides them with a lot of NGL barrels, and so now ONEOK can go and find a home for those barrels and build its own downstream infrastructure even more to get it there. If we just look at Enlink's Permian GMP systems, they produce close to 250,000 barrels a day of NGLs, 150,000 barrels a day of which they can market. So Enlink already ships on ONEOK's West Texas NGL pipeline, but those volumes are also sent on ET's Lone Star pipeline and Phillips 66's Sandhill pipeline. So depending on how much they have left to capture, we expect that can translate to another 72 to 95 million across its pipelines and fractionators. And that's just on the marketed side and ignoring the potential benefits from the recent Easton acquisition, which essentially distributes those NGLs and purity products to the end users. So if we assume that they can capture the full 250,000 barrels a day that Enlink's producing, and then they can also distribute it on Easton, that's up to $200 million in annual EBITDA for ONEOK. Lastly, again, I want to note that that's also only in the Permian. Enlink more than doubles ONEOK's plant production. So a lot of Enlink's production already moves on ONEOK's pipelines in Oklahoma. So the Permian is the main source of the upside here, but I think the bigger thing is the fact that ONEOK has access now to almost 800,000 barrels a day of NGLs.
Jay, thanks for covering that. Very interesting in the market right now. Exports are a hot topic as well. Wonder your thoughts around ONEOK Enlink export synergies here.
Yeah, I mean, I think what Enlink does is, again, it provides ONEOK access to these barrels to then potentially go and enter that export market. And I think one interesting case in particular is the ethane export market. Now, I know a lot of the focus has been on LPG exports, but I think just given the fact that there's only a couple of players right now in the ethane side, it could make it a good opportunity for ONEOK to target that market instead. So digging deeper on Enlink and the ethane production alone is about 150,000 barrels a day. Since Enlink does not have any downstream benefits to recovering C2 when the frac spread does not make sense, ONEOK on the other hand would have higher incentives, as more C2 volumes means more volumes in its pipelines and fractionators. So an opportunity here could be for ONEOK to maximize Enlink C2 recovery. And then the next step would be for them to leverage those volumes to maybe break up the current duopoly in ethane exports.
Jay, thanks for that. Thanks for covering our production numbers and also the NGL section. I'm going to bring in Zach Krause, who covers nat gas for us on the capital intelligence side. And the big question everybody has is Blackcomb, which heads down to Agua Dulce to South Texas, a nat gas pipe. So Zach, I know you're a Chicago sports fan. So the question I have is Blackcomb going to flood the South Texas market with nat gas like defenses flood the Chicago Bears backfield?
Well, Chris, you know, the Chicago Bears backfield has a lot of holes up with that offensive line. I don't think the oversupply situation in South Texas would be quite that bad. I don't think it can be that bad. So what we're looking at with this Permian egress situation is the first pipe we have coming online is again Matterhorn in the fourth quarter of 24, which will bring eastbound Permian egress to about 3.3 BCF a day of capacity. And then that next project is Blackcomb, which will bring an additional 2.5 BCF a day out of the Permian to the Agua Dulce hub in South Texas. And again, that'll bring our total eastbound capacity to about 15.8 BCF a day from that Waha price point eastbound out of the Permian. But uniquely down to Agua Dulce, this developing hub in South Texas, we have several pipes like Gulf Coast Express and Whistler. And when Blackcomb enters the mix in 2026, there'll be a combined capacity of about 9.3 BCF a day that goes from both the Eagle Ford and the Permian into Agua Dulce. And then after it reaches Agua Dulce, it's going to go up to LNG facilities or down to feed Mexican demand.
So 9.3 BCF going into that market, Agua Dulce, that's a lot. So can you talk about the timing of LNG facilities, what this may look like for the future of this hub?
Yes, so with this hub in particular, you know, there's two South Texas LNG facilities we're looking at in Texas LNG Brownsville and Rio Grande LNG that are not expected to reach full service until 2028. And that's leaving an about 2-year gap between that 2026, second half of 2026 in-service date for Blackcomb and the 2028 full in-service of those facilities. That's creating a significant opportunity for there to be an oversupply situation in South Texas that will place risk on that Agua Dulce price point for producers.
Well, that's a good segue. Producers, how are they going to be affected by this? I know you cover them. We look at producers as well in our data and our products. Talk to me about how producers are affected.
Absolutely. So there's major GMP systems down there, like those owned by MPLX and Targa, that are backed by, again, major producers such as Exxon, Conoco, and Chevron that are stepping up to back these egress pipes. And while Blackcomb is going to allow these producers to escape negative price points at Waha, there's going to be this oversupply situation in South Texas that's going to widen basis between Agua Dulce and Henry Hub. And while the price in Agua Dulce might not be negative like that in Waha, that widening basis is still going to stop producers from reaching those premium price points that's going to affect their production outlook. And then that production alteration is then going to affect the GMP systems we see for MPLX and Targa in the Permian.
Thanks, Zach. Interesting commentary. I hope the Bear season goes better than anticipated for you.
Thank you.
And not like the Chicago White Sox season. So moving on to the winners, but first let's cover Producers do have an uphill battle, as Zach laid out, to capitalize on this dynamic. But there's definitely going to be a winner in this dynamic. And I'm bringing in James Taylor, who's also on our capital intelligence team, to talk about Targa and their exposure to STX. They're positioned pretty well, James.
Yeah, Chris, thanks. I'd say Targa is uniquely positioned to capitalize on both sides of this position. Targa is currently expanding their Permian processing capacity by 1.3 BCF a day between now and year-end 26. And as we saw on the last slide, their Permian system is primarily backed by large growth-oriented customers such as Exxon, Chevron, Conoco, and EOG. And Targa's position in Blackcomb could incentivize drilling on their system, which will help fill up these plants in these planned expansions. And Targa's plants are always highly utilized, and we currently project a 90% utilization rate between now and the end of 2028, which we estimate will provide over $350 million in EBITDA growth to Targa going forward.
Thanks, James. Hey, quick question on that. What happens if they don't fully utilize those plants?
So if they don't fully utilize these new expansions like we expect them to, they still have a downside edge in their position in the Blackcomb pipeline, which we estimate will provide $62 million in earnings going forward. And if they do fully utilize these new plant expansions, they could potentially monetize their stake in Blackcomb, similar to the way they did with Gulf Coast Express back in 2022.
James, thanks for covering the Permian dynamics there, and Targa is positioned well to capitalize on that upside. So next, let's switch it over to a basin that has long been forgotten, but we think is really interesting right now, the Bakken. So I'm going to bring in who we affectionately call the Ragin' Gagin, Gage Dwan, who covers crude, but also covers the Bakken completely. So Gage, welcome. Can you tell us why the Bakken's so interesting right now?
Yeah, certainly. Thanks, Chris. In the Bakken, crude oil egress is not currently constrained. In the chart on the right, the stacked area is the historical and the forecasted pipeline volumes. And so when Kinder Morgan converts its Double H pipeline to NGL service, as we can see, egress will be tight, and as production increases, egress will become constrained.
Thanks, Gage. Very interesting dynamic. So we're taking off Double H. We have production growing in the Bakken. So we got to figure out where those barrels are going to go.
Right. So this is a map of the Bakken and its associated crude egress pipelines. The purple highlighted shape is the region East Daley associates Bakken production with. So today, Double H has a capacity of 88,000 barrels a day and a throughput of 68,000 barrels a day. Bridger pipeline is at 245 and is capable of 285,000 barrels a day. DAPL has 682,000 barrels a day flowing through its 750,000 capacity, and the North Dakota pipeline is currently full, while the Bakken pipeline has no throughput. So getting into these dynamics, when Double H goes offline, the Guernsey market is going to lose that capacity, and with North Dakota pipeline already full, the egress options become limited. So to make up for it, Bridger is going to be able to absorb 40,000 barrels a day, and the remaining 28,000 barrels a day will move over to DAPL. However, as I mentioned earlier, we also have production growth in the basin to account for, which we're forecasting to be about 90,000 barrels a day by the end of 2025. This is where the underutilized Bakken pipeline comes in, despite its downsides. So DAPL will fill up with less than half of the basin's production growth, and the remaining 50,000 barrels a day will move over to the Bakken pipeline.
Thanks, Gage. So with our production, we're going to have to find a place for those barrels, but there's two midstream companies that are going to gain from this. It's Enbridge and Energy Transfer. They're going to gain from the conversion of Double H. Could you talk a little bit about their upside?
Yeah. So when we're considering the upside to both Enbridge and Energy Transfer, we have to take into account the transportation costs per barrel across these different systems. And on an uncommitted basis, it's more expensive to get a barrel to the Gulf Coast via the Enbridge system than it is via Energy Transfer. And so we have two cases for each midstreamer here, which are essentially a base case and a best case. For Enbridge, the base case includes a minimum volume commitment from a May open season on the Bakken pipeline, plus the impact of those barrels on mainline and Flanagan South pipelines to the Gulf Coast, and Enbridge's EBITDA share from volumes increasing on DAPL and ETCOP when WH converts. In this scenario, Enbridge is likely to see about $114 million in annual EBITDA increase, while in the best case, it is possible the EBITDA increase will be as high as $240 million annually. The best case takes the same factors into consideration, but it also includes volumes from the forecasted Bakken production. As for Energy Transfer, the upside is not nearly as substantial as it is for Enbridge, though it's not a small figure either, especially as ET wholly consolidates EBITDA from DAPL and ETCOP, despite only owning a little bit more than 36% of the system. So the base case for Energy Transfer includes the volumes it will likely gain from WH, and the best case includes the WH volumes and the base of production growth. On an unconsolidated basis, the two cases could yield between $35 million to $75 million in annual EBITDA, and on a consolidated basis, the upside is $96 million for the base case and $205 million in annual EBITDA for the best case.
Thanks, Gage. Appreciate it. The Bakken is indeed interesting. Another dynamic we saw recently was the M&A action by producers up there. And a lot of producers merged and became much larger. So I'm going to bring back Ajay here. Ajay, we do cover producers. We look at their dynamics. I'm wondering how you see their strategy shifting in the Bakken.
Thanks, Chris. Yeah, as you said, a lot of consolidation this past year in the Bakken, but these top 8 producers now control about 80% of crude oil production growth in the region. And I think the main thing is they should be aware of these upcoming constraints. You know, they have two options here. They either have to cut back on their planned production growth, or they have to start exploring for infrastructure expansions to ease these constraints. Otherwise, you're going to see that Bakken differential blow out, or they have to pay through the roof to ship on the Enbridge Bakken line and then main line and Flanagan South to get it back all the way to the Gulf Coast. So again, one is dial back that production growth and essentially just hold production flat, or expansions. There's two options here, Bridger and DAPL. DAPL might be tough just given its legal history, but I think Bridger could make sense, especially since WH is taking barrels away from Guernsey. Bridger can add those back. They were exploring I think Bridger was exploring an expansion as a JV with Phillips 66 about 5 years ago, and so we know that they have some plans already potentially in the works, or at least ready to take off the shelf. And that's also going to benefit some of those pipes in the DJ area that source volumes from Guernsey, like Tallgrass's Pony pipeline and One Oak and Plains Saddlehorn pipeline. So it's time for these producers to start thinking about Bakken crude egress again. And I know it's been a while since they've last had to do that.
Thanks, Ajay. Well, everybody, thanks for joining us on this call. Time for us to wrap it up. We've got a ton of data and resources behind this. I want to thank our capital intelligence team, Ajay Bakshani, James Taylor, Zach Kraus, and the Raging Gage Dwan. for joining us today. If you have questions, please don't hesitate to reach out. We actually put you directly in touch with the analyst you heard from today, and we'd love to hear from you.